So we're handing over to Elaine now. Elaine is going to come from a slightly different angle. Elaine is looking at government grants and intangible assets other than goodwill. And obviously there's COVID is a reason to look at this, but Elaine has a very specific reason as to why we should look at this, and she's going to touch on some of the accounting issues for you to keep an eye on as we move into 2022.
Hello, everybody. Delighted you're all here today, our big UK following. I'm so happy to be on this, and they're all joining us at Christmas time. Well done. Today, so in this session, I'm going to be covering the financial reporting requirements under FRS 102 for government grants and intangible assets. And I will touch on accounting treatment for the most common scenarios affecting your companies. I believe these are two important and relevant topics for UK accountants at the moment, especially with the government initiatives that are going on at the moment for the companies that you are looking after. So let's put a reminder up here. It's the Innovate UK Smart Grants. October 2021 was when it opened, and that's going to close on the 12th of January 2022 at 11 a.m. with a deadline coming up in the new year. So let's look at government grants then. What is a government grant? Why is it relevant? So it's government, it is assistance by the government in the form of the transfer of resources in return for compliance, past or future, with certain conditions in relation to the activity of the company. And when are you recognizing that government grant in your financial statements? So government grants shall be recognized until shall not be recognized until there is a reasonable assurance that the entity will comply with the conditions attaching to them. So the conditions of the grant, and the grant will be received. So where in your financial statements should the government grant be recognized if it is a monetary grant? Well, this depends on whether the entity is using the performance model or the accrual model. So clear distinction, there's two models that you're going to be looking at. The performance model is all about related conditions of the grant. And if we look at kind of in depth into the performance model, there's three conditions there. So a grant that does not impose specified future performance related conditions on the recipient is recognized in income when the grant proceeds are received or receivable. A grant that imposes specified future performance related conditions on the recipient is recognized in income only when the performance related conditions are met. And grants received before the revenue recognition criteria are satisfied are recognized as a liability. So again, the three of them are really honing in on those performance related conditions. And let's look at the accruals model. So this is quite different. If an entity is applying the accrual model, it should classify grants either as a grant relating to revenue or a grant relating to assets. Grants relating to revenue shall be recognized in income on a systematic basis over the periods in which the entity recognizes the related costs for which the grant is intended to compensate. And grants relating to assets shall be recognized in income on a systematic basis over the expected useful life of the asset. Where part of the grant relating to an asset is deferred, it shall be recognized in deferred income and not deducted from the carrying amount of the assets. So that was the old way. That's just not acceptable anymore. We're not deducting the grant from that asset. We're deferring it and releasing it on a systematic basis. So the accrual model is all about that matching concept. The grant recognized relates to the cost or the depreciation recognized by the company in that accounting period. That's the performance model and the accruals model. And then I suppose from the FRS 102 accounting disclosures point of view, we're happy that we recognize the grant. We're happy, that we've either chosen the performance model or the accrual model. And now we just need to get those disclosures right in our financial statements. So we really want to hone in on the accounting policy. So it said that's your performance model or your accruals model. The nature of the grant recognized in your financial statements. So that's where we're going to disclose who awarded the grant. So hopefully for some of your clients, they got that Innovate UK grant, a share of that 25 million on offer. It's like the lottery. Whether the grant relates to revenue or assets, you're going to disclose whether the grant is a monetary and non-monetary grant, the amount of the grant awarded, and the amount of the grant recognized in the financial statements. The next thing there is the unfulfilled conditions and other contingencies attaching to grants that have been recognized in income. This is important. You need to fully understand those conditions of the grant so that you can clearly outline any unfulfilled conditions and other contingencies. That's going to impact on other disclosures in your financial statements. When the person reads the conditions or the contingencies, they will look at the accounting policy and check that you've applied that accounting policy correctly. The next one there is an indication of other forms of government assistance from which the entity has directly benefit. So you might have got government loans or government guarantees during the year. The key point there that I'm trying to make there is the performance model is all about performance related conditions. The accrual model is all about the matching concept. The grant recognized relates to the actual cost or depreciation recognized in the company in that accounting period. My final key point is where a grant becomes repayable, it shall be recognized as a liability when the repayment meets the definition of a liability.